great big spree, the jazz age, is over, all over. In the 1920s, the great American word was prosperity. Now the 30s have begun and there is a new word, depression.
There's a popular saying that history doesn't repeat, but it often rhymes. In 2022, the investing world and financial markets have been hit with unprecedented events that have sent stocks, bonds, cryptocurrencies, every investment into wild swings with a significant bias downwards. We are dealing with inflation that we haven't experienced for 50 plus years, interest rates that are finally coming off near 0% to now 4% and potentially going higher, war in Europe with an increasingly aggressive adversary in Russia, a brewing energy crisis in Europe, and to top it off, we have a potential invasion of Taiwan by China in the future. Putting all this together, this is quickly becoming the most challenging environment for investing that we'll probably ever see in our lifetimes. How do we navigate this? Investors are turning to the past to try and find analogs to the challenges in the present. Implementing these analyses requires a deep understanding of history and experience in financial markets. How can new investors utilize similar tools? We at WEWAVE have automated this process utilizing our patented algorithms that find similar patterns in the past. Let's do a deeper dive. Here we are looking at the S&P 500, or the 500 largest publicly traded companies in the USA over its entire public history. By extending the pattern match zone from the beginning of this year to the latest price as of October 2022, our algorithm matches with several key time frames to assess further. Let's look specifically at the September 1981 match of 94%, the December 1952 match of 93%, and August 1973 match of 92%. We can see that if the S&P 500 were to follow the September 1981 match, it looks like we'll see a quick rebound, another retest of the lows, but in the long run, a bullish run that will result in approximately plus 30% gains from here. If we follow the December 1952 action, plus 10.5%, and if we follow the 1973 match, it looks like minus 30% from the current levels. So which do we follow? How can we expand on these matches to utilize as a map for where the markets go from here? Before we dive deeper into the various historical matches, we need to lay out a framework for what to look for. Our platform has identified where the chart patterns are similar, but what else can we identify in our study to deepen the ties between present and past? To start, we can look at key economic indicators that are driving fiscal and monetary policy today and compare this with the historical matches our platform has identified. We will go over these select indicators in detail next, but in general, this is where the analysis becomes more of an art rather than a science. The mindset to adopt is, what is everyone focusing on today? Easy answer is inflation in 2022. So what was inflation like in the past that our historical pattern match has identified? What other economic indicators today can we draw parallels to in the past? Let's explore. Before we get into some context, some economic data points as references to these eras is required. Today we'll cover 4 key economic indicators as analogs to the present. These 4 economic indicators are 10-year interest rates, inflation as measured by CPI, US dollar, and unemployment rate. Interest rates have a significant impact to economic activity, and there is robust history to draw from. Today's 10-year interest rate is a little over 4%. Year after year, inflation has been grabbing headlines all year. As of the latest print, the year-after-year CPI is approximately 8%, but it's important to remember that 3 months ago in June, it was 9%. While it can be argued that CPI is decelerating, let's just keep in mind that the potential for it to increase again and go beyond the high print of 9% in June is possible. Another headline grabber this year has been the strength of the US dollar. To assess the strength of the dollar, we'll look at the DXY index, which is a weighted index of various currencies from other Western nations, like the UK and Japan, versus the US dollar. Today the DXY is up 10%, but was up as much as 17%, representing multi-decade highs. Lastly, the economic indicator we want to look for in the past is the unemployment rate. Today's unemployment rate is at a mere 3.7%, coinciding with levels that are indicative of a strong economy. Has to be a joke, right? It is. This is a strong reminder that the US economy is not all about tech. Examining the 1981 match then, let's put all of these economic data points from today versus 1981 in a quick table. We source data from the Fed and other sources linked in the description. Here are some other historical events that occurred in 1981 here. we highlight what we think is important as it differs from what is happening today. Remember a month or so ago when Biden negotiated with railroad workers, giving them a 24% raise? In 1981, Reagan rejected a similar proposal by the air traffic controllers in the US. Putting all this together, the pattern match with the 1980s was a decent analog in the sense that the economic indicators then are similar to some of the key indicators investors in the world are focusing on today. However, the argument can be made that there are some significant differences. One being is that it would be unimaginable for political leadership today to outright fire swaths of labor force as a rejection of increased salary pay demands. One consistent theme of political leadership in 2022 is the advocacy and support of pro-labor policies. In the 80s, this was not the case. This is somewhat evident in the nearly 2 times difference in unemployment, 3.7% today versus 6% back then. Investors new and experienced must keep in mind that the Fed monetary policy, by raising interest rates, is actively attempting to increase unemployment. In the 1980s, this was the case, same as it is now, but in the 1980s, you had the fiscal authorities in the White House contributing to the cause. In the 1950s, while there were some parallels we can draw to 2022, there are some stark differences worth mentioning before we put in more work. Let's look at some key events in 1953. The US and North Korea sign an armistice ending armed conflict in the Korean War. The Soviets' Joseph Stalin dies. Queen Elizabeth II gets crowned. These are very different circumstances with today. While the argument can be made that a potential truce in the Russia-Ukraine conflict is near, one overarching theme is certain. In the 1953s and onwards, the world was exiting multi-year conflicts, whereas today in 2022, the facts are that we are more at the beginnings of multi-year conflicts rather than the end. From Russia-Ukraine to China-Taiwan, and the deteriorating globalism that powered the last 10 to 15 years of the economy, there are multiple headwinds that face us. In terms of economic data points, let's take a quick glance before we move on. While there are some similarities, the most significant is the lack of inflation in the 1953s. This is extremely important because when inflation is low, the Federal Reserve and government have much more flexibility in terms of turning the money printer on, passing bills and laws that increase spending, as the consequences are inflation. If there is none, then print and spend away. When there is inflation, this becomes a non-starter. Now let's do a deep dive in the 1970s. From the Nixon Library on the 70s. Many remember the 1970s as a decade of soaring inflation, political upheaval, and the erosion of United States prestige worldwide. Does this sound oddly familiar? You're not alone. For the purposes of investing and trading, let's first go over some key similarities in the present. But just as a forewarning, there is a significant difference in the challenges we are facing today that the 1970s did not have to endure that we will cover in more detail after. The similarities with today and the 1970s. Inflation. The average inflation rate from 1970 to 1979 was 7.1% versus an average of 2.5% from 1900 to 1970, nearly 70-year highs. Energy crisis. Though it peaked in 1973 and 1979, the overall realization that oil reserves were not endless and technological development was not sustainable without potentially harming the environment ended the belief in limitless progress that had existed since the 19th century. During the peaks of the energy crisis, the US implemented rations on oil, for example, by only allowing US citizens with odd-numbered license plates to purchase gasoline on some days, and vice versa. Unprecedented for a nation like the US that is arguably one of the wealthiest nations in terms of energy. War. While the Vietnam War for the US started in 1965 with the first arrival of ground forces in Vietnam, the war crested into the 1970s, eventually ending in 1975 with the surrender of South Vietnam. A stark reminder that the war was actually fought by the South Vietnamese supplemented with US military advisors and weapons supplied by the US that started around 1960 until the US formally entered with ground forces in 1965. We won't go into too much details here, but the way the US justified the use of ground forces as a result of the arguably fake Gulf of Tonkin incident is also something that is very possible today. Fake attack on the US to get approval for a full-fledged war? Can this happen with Ukraine? The parallels between these three factors of society with today is quite interesting. In addition, there were upheavals in politics, thought process, and a myriad of other non-economic related factors that we encourage you to explore further if this interests you. Other than that, here's a quick table of our key economic indicators we want to compare with. In the 1960s, 10-year rates were 4%, then jumped to 8% in 1970, then went higher to 12.6% by 1980, before peaking in 1981 at nearly 16%. Today's 10-year rate is approximately 3.5%, and mortgage rates are already near 7%. This era is what gives the Fed/Jay Powell so much concern, and is perhaps the main driver of their aggressive policy. CPI was 1.6% in 1965, basically nothing, then accelerated to 6% in 1970, then crashed to 3.2% by 1972, before re-accelerating to 12% in 1974, then crashed to 5% before reaching a crescendo in 1979 of 11.8%, 1 year later in 1980 of 14.5%. In the 1970s, the dollar was extremely strong as measured by the DXY index level of about 121. Throughout the decade though, the dollar weakened considerably, reaching a low of about 85 by the 1980s. Shortly after, it went on a historic run to its all-time high of 160 by 1985. Reminder that in the 1970s, the US did not discover the necessary tech to be energy dependent, which is different versus today. The US in the 70s was beholden to energy producers, whereas today, a simple pen stroke from the president is all that we need to be self-sufficient, energy-wise. Entering the 1970s, in 1969, unemployment was at historic lows of 3.4%. Within 1 year, this almost doubled to 6.1% in December 1970. 5 years later, in 1975, we'd see the decade's peak unemployment at 9%. By 1980, unemployment settled at 6%. Suffice to say, out of the three historical pattern matches shown so far, the 1970s provide the closest parallels to the present in 2022. Although not a one-for-one perfect match, it's always good to remember the saying that history doesn't repeat, but it often rhymes. Assuming we follow the 1970s chart pattern, it looks like we're in for a very rough decade for investing, especially for passive investors who only know of nosebleed gains the longer they're invested. While our pattern match shows a significant drawdown if we follow the 1970s pattern, there are some picture facts from the 1970s that need to be included in the investor/trader's calculus moving forward. From the 1970s to 1980, the S&P 500 or SPY ETF was flat, as in everyone who bought the S&P 500 got 0% after 10 years of waiting. That is a stark contrast to what we've been experiencing for the last several decades. Was it all just the Fed and its money printing? Were all these gains just a mirage and a function of endless money printing? The critics of the Fed's money printing over the last decade were all silenced given inflation never really surfaced, which gave the Fed the green light to print more. Now that inflation is here, the game has fundamentally changed. If you stuck through so far, we're finally here. The end game. We've shown you in great detail how you can use WEWAVE's historical pattern match and conduct an extremely detailed investment thesis for what's coming and what will come from markets going forward. The big difference from prior approaches is you do not need to have a deep understanding of financial and economic history to get started on these analyses. Our AI has shortcutted the hardest parts of the process, which requires years of experience in trading or via mentorship from a veteran trader at a cushy job on Wall Street. So with that being said, the end game. The 1970s, as we've previously discussed, provides quite a nice parallel for the challenges we're facing in 2022. Researching the events of this decade are jarring. It isn't hard to see that the average citizen in the US and globally at the time was under immense uncertainty and stress. As someone who just looks back on the 70s, there is a level of comfort given the US eventually got its act together and emerged from this decade arguably stronger than it's ever been. But what was the cost? What did it take to defeat inflation then and jumpstart the economy? Wall Street veterans will bring up Paul Volcker as one of the architects of figuring out the solution to these problems. Volcker was appointed to chairman of the Federal Reserve in 1979. Prior to his appointment, the federal funds rate was flopping back and forth from accommodative to restrictive for many years, which Volcker argued was one of the primary drivers of the persistent inflation the US faced during this time. He called a special meeting in October 1979 in which after he raised rates to a whopping 13.7%. By 1981, the rate was near 20%. These actions also plunged the US economy into a recession, and it can be assumed that he was not a very likable character by investors or the public at the time. Ultimately, Volcker had the last laugh, as in hindsight, his decisions were a necessary medicine for the US economy. Why are we bringing this up? Because the next sensible jump is to say, why doesn't Jay Powell just raise rates to double digits and snuff out inflation for good, right? Let's look at that GDP. Remember, when the Fed raises rates, the US government also is on the hook for higher interest payments on all money it borrows. In 1970, debt GDP was 35%. By 1980, it was at 30%. All this says is that the Fed had a lot of headroom to raise rates as the government could afford the subsequent interest payments. Today in 2022, debt GDP is literally 120%, peaking at 134% in 2020. There is a literal threshold of rates that will make the US government unable to pay interest payments. Also, the interest payments in the US government's budget is set to exceed the US spending on its military, social programs, everything. It will be the #1 expense in the not-too-distant future, if not already. Which brings us to the end game. The Fed is crossing its fingers, sending up its prayers that the current rate hikes that currently are set to peak at 5 to 6% is enough to bring inflation down. This is because, for all intents and purposes, the Fed cannot raise rates higher from there, as the government will be unable to afford paying its debt back. I mean, do you really think the Fed will purposely push the US government into insolvency? Not a chance. By the way, if the government can't pay its debt back, guess who the largest holder of its debt is? The Fed. They will be insolvent as well. But who cares, right? They can just reprint money to pay the debt back. No. This luxury is no more because of inflation. When there is little to no inflation, of course print away. Now that inflation is getting embedded into the economy, the Fed cannot print money to save anyone because the risk is hyperinflation. Readers of history will know that hyperinflation has a 100% cure rate for society. Every nation in history that has come face to face with hyperinflation fell apart from the inside out. Weimar Germany, Argentina are recent examples. Rome, an arguable example of the distant past. So assuming inflation sticks around and the Fed doesn't get their prayers answered, the ultimate decision will come. Hyperinflation as the result of printing money to temporarily save the economy, or insolvency, aka US government bankruptcy and the restructuring of the Fed as a result of more rate hikes to crush inflation for good? Which will Jay Powell choose? End game. While all of this seems extremely dark and unsettling, before we conclude, just want to mention that all of the greatest investing opportunities in history were often created during the darkest, most uncertain times in the markets. It's so easy to quote Warren Buffett during a raging bull market to be greedy when others are fearful and fearful when others are greedy. This year and the next couple is really going to put this to the test. On the flip side of it all, what gets us out of this mess? Outside of an emergence of common sense policy from our elected officials, human innovation has had a 100% success rate in fixing nearly all of the ongoing problems humanity faced. At least from the perspective of a trader, this mini tutorial on WEWAVE's tools, in addition to a wide variety of other features we've been working on, should give you the adequate tools to navigate these markets, and if you manage to do so, you will become an elite investor as a result of it. This era will likely be the most challenging markets we'll ever experience. Until the next crisis. Thanks for watching! Let us know if you have any questions or comments about our content, and we appreciate your support for WEWAVE.APP.